How to trade crypto with leverage in Australia. In this video, we'll break down the definition of leverage trading, explain how you can trade crypto with leverage in Australia with bitcoin.com.au, and show you some examples of how it all works. Okay, let's get started. Leverage trading is when you borrow money so you can place a bigger trade than what your current balance would normally allow. A leveraged crypto trade allows you to amplify the size of your position in the market. So, how does this work in practice? This is Jeff. Jeff has $1,000 and is looking to invest in Bitcoin. Jeff's crypto exchange, bitcoin.com.au, offers up to 5 times leverage, which means that for every dollar Jeff has, bitcoin.com.au can lend him another $4, giving him a position of $5,000 from a $1,000 deposit. Jeff expects Bitcoin's price to rise in the short term, so he opens a 5 times leveraged Bitcoin position using his $1,000 in collateral to borrow $4,000. Over the next week, the price of Bitcoin rises by 5%, bringing the $5,000 position to $5,250. At this point, Jeff closes his position and repays the $4,000 for a total profit of $250, excluding fees and interest. Without leverage, Jeff would have made $50. But leverage works both ways. Imagine this time Jeff's prediction didn't come true. With $1,000 of his own money and $4,000 borrowed from his exchange, Jeff opens the same 5 times position on Bitcoin and waits for the price to go up. Only this time, Bitcoin falls by 5%, turning his $5,000 into $4,750. Jeff closes his position, worried that the price may drop even further. After repaying the $4,000 borrowed, Jeff is only left with $750, a $250 loss on top of fees and interest, or 25% of his original capital wiped out by a 5% market move. Without leverage, Jeff would have only lost $50. Leverage trading can also be used to take a position on a falling price. A leveraged sell position profits if the asset's price decreases and loses if the price increases. Say Jeff holds $1,000 worth of Bitcoin and thinks the price is about to drop. He opens a $5,000 leveraged sell position, putting up his $1,000 as collateral while the exchange provides the remaining $4,000. That's 5 times leverage. In effect, Jeff has sold $5,000 of Bitcoin at today's price and will need to buy it back later to close the position. If Bitcoin falls by 10%, the $5,000 leveraged sell position costs only $4,500 to buy back. He closes the position and keeps the $500 difference, a 50% gain on his $1,000 collateral. If Bitcoin rises 10% instead, buying it back costs $5,500. Jeff loses $500, half his collateral, from a single 10% move against him. The same leverage that multiplies gains also multiplies losses. Because leverage positions are funded partly with borrowed money, you are required to keep a minimum amount of your own funds, known as margin, in your account at all times. Think of this as a healthy collateral buffer, usually tracked as a margin ratio. Your remaining equity as a percentage of the position's value. If the market moves against your position and your margin ratio falls toward a set threshold, often around 15%, the exchange issues a margin call. This is a request to either deposit more funds or reduce your position to restore your margin. If the market keeps moving against you and your margin ratio falls below the liquidation threshold, often around 10%, the platform automatically closes your position. This is called a mandatory liquidation, and it can result in the loss of your entire collateral. Margin calls and liquidations can happen quickly, particularly in volatile markets like crypto. There is no guarantee you'll have time to respond to a margin call before liquidation occurs. It is a high-risk product that is not suitable for everyone, and you could lose more than your initial deposit. Before you can access leverage trading on bitcoin.com.au, you will need to pass a knowledge test to confirm that you understand how the product works and the risks involved. Learn more about leverage trading through the links in the description below.